You did everything right. You watched the market fall. You waited. You told yourself you would buy when things got cheaper, and then, when prices finally dropped, you did the one thing no one talks about. You sold. Not because you panicked, but because it felt like the smart move. And that feeling, that calm, rational, completely convincing feeling that you were making the right call, that is the most dangerous thing in investing. Not greed, not fear, certainty. Because the mistake that destroys more wealth than any market crash, any bad stock, any wrong mutual fund, is not the one that feels wrong. It is the one that feels perfectly, logically right. Let us talk about why your brain is wired to make this mistake, and why, the smarter you are, the worse it gets. In 1979, a psychologist named Daniel Kahneman and his colleague Amos Tversky published a paper that quietly changed everything we thought we knew about human decision-making. It was called prospect theory. And what they found was uncomfortable. When people face a potential gain, they become cautious. They take less risk. They protect what they have. But when people face a potential loss, something switches. They become gamblers. They take more risk to avoid locking in a bad outcome. Your brain does not treat gains and losses equally. Losing 1,000 rupees feels roughly twice as bad as gaining 1,000 rupees feels good. This is not a personality flaw. It is not a sign of weakness. It is how human cognition is built. And in investing, it turns into a very specific, very costly pattern. When your portfolio goes up, you feel smart. You feel like you have something to protect. So you sell early. You lock in your gains before the market can take them back. You leave the table while you are winning. When your portfolio goes down, you feel like you are in a losing battle you can still escape. So you sell, not because the investment is bad, but because the number on the screen has become painful to look at. Both of these decisions feel right, and both of them slowly bleed your wealth away. There is a name for this. Behavioral finance researchers call it the Disposition Effect. It was formally studied by Hirsch, Sheffrin, and Meir Statman in 1985, and what they found in real brokerage data was stunning. Investors across the board were selling their winners too early and holding their losers too long. Exactly the opposite of what a rational investor would do. And they were doing it consistently, repeatedly, and with complete confidence that they were making sound decisions. You probably recognize this. Maybe you have done this. You bought a mutual fund, it went up 15%. You thought, I should book profit before it falls, and sold. Then watched it go up another 40% without you. Or you bought shares in a company you believed in, they dropped 30%. And instead of exiting with a limited loss, you held on, convinced it would come back, while the money that was trapped there could have been working somewhere else. Neither of these mistakes looks like a mistake in the moment. They look like prudence. They look like strategy. And that is exactly the problem. Now consider what happens when the market itself starts to fall. Not your stock, not your fund, the entire index, the Nifty, the Sensex, everything drops. This is when the most damaging mistake of all begins to feel the most reasonable. In March 2020, Indian markets fell nearly 40% in a matter of weeks. Every news channel was explaining why this was only the beginning. Every WhatsApp group had a message about how much further things would drop. And millions of investors who had been investing in SIPs month after month suddenly paused their SIPs, or stopped them entirely, or worse, redeemed everything and moved to fixed deposits. They did not do this out of ignorance. Many of them knew the theory of buying low. They had heard it, they had read it, but knowing something intellectually and feeling something emotionally are two entirely different systems in your brain. And in March 2020, the emotional system won. By December 2020, the Nifty had recovered everything it lost. By 2021, it was at all-time highs. And the investors who had stopped their SIPs, who had moved to safety, did not participate in that recovery. They had sold the dip, not in a panic, but in what felt like a careful, considered, adult decision. This is the mistake that feels like the right decision. A researcher named Brad Barber at the University of California studied trading behavior across 66,000 households over 6 years. He found that the more frequently investors traded, the worse their returns. The top 20% of traders by frequency earned returns nearly 7 percentage points lower per year than investors who barely touch their portfolios. 7 percentage points. Compounded over decades, that is the difference between retiring with enough and retiring with a fraction of what you needed. And these were not reckless gamblers. These were engaged, active, informed investors. People who were paying attention. People who were trying. And the trying, the constant reevaluating, the constant optimizing, the constant feeling that now is the time to act, was costing them a fortune. There is a term in behavioral finance, action bias. Human beings have an innate tendency to believe that doing something is better than doing nothing. It goes back deep in your evolutionary history. Standing still when a threat was approaching was dangerous. Movement was survival. Action meant control. But the stock market is not a predator, and acting on every signal your brain sends you, every nervous twitch of the market, every uncomfortable feeling when your portfolio turns red, that action bias does not protect you. It quietly, methodically destroys your returns. The antidote is not complex, but it is deeply uncomfortable because it requires you to do the thing that feels wrong. It requires you to keep your SIP running when the market drops 20%. It requires you to let your winners run instead of selling the moment you see a profit. It requires you to accept that an account you barely check will almost always outperform an account you optimize every week. There is a famous story, possibly apocryphal but instructive, about a fidelity study that found the best performing accounts were either accounts belonging to people who had died or accounts belonging to people who had completely forgotten they had them. Whether the exact study is real or not, the insight it captures is real. The best investor behavior is often the absence of behavior. This does not mean ignoring your investments forever. It does not mean never rebalancing or never reviewing. It means understanding that the discomfort you feel when markets fall is not a signal to act. It is a signal that your brain is doing exactly what it was designed to do, in an environment it was never designed for. The market is one of the few places on Earth where the correct response to danger often looks like doing nothing. Where patience is not passivity, it is the strategy. Where the investor who checks their portfolio once a year frequently beats the investor who checks it every morning. You are taught that effort leads to reward, that attention leads to better outcomes, that staying informed means staying ahead. And in most of life, that is true. But the market rewards conviction more than cleverness. It rewards time more than timing. It rewards the investor who can sit with discomfort more than the investor who resolves that discomfort by clicking sell. So the next time your portfolio turns red and your brain presents you with a calm, rational, completely convincing case for why selling right now is the smart move, remember that this feeling has a name. It has been studied for 40 years. Thousands of investors have acted on it before you, and almost all of them looked back and wished they had done nothing. You did everything right. You saved. You invested. You built a portfolio. Now do the hardest thing of all. Do nothing. Thank you for watching. If this video added value to your financial journey, please consider subscribing to FinsetWealth. Like, share, and comment. It really helps the channel grow and allows me to create more content to help you build wealth. See you in the next one.